Hello, option traders. This is Sam, the Trader Geek, with a tutorial on tactical trading approaches with weekly options. And so here's a little bit of my background. I have been an option trader for about, uh, say, call it 15 years, been trading for almost 19 years. And I thought we'd start a little bit of introduction and talk about weekly options and get you some of the practical approaches that we have to trading them. So here we go. Let's see if we can get this moving. So what are weekly options? Obviously, if you've been trading any options, even if you're a beginner, you know we have monthly options and we have weekly options now, and then we also have daily options. We call those the zero DT options that expire every day of the trading week. So they've come a long way. We started with monthly, and I think they started with quarterly. And your standard monthly options expire on the third Friday of each month. And when weekly options started, that goes back to, I want to say around 2017, 2018, when some people say it was Think or Swim guys who introduced them, but the Chicago Board's Options Exchange, the CBOE, is really where they started them out. And the way they started out is basically they introduced the Friday option, and you only really got to trade the weekly option on the Thursday and Friday of the prior week, and then for the rest of the week. But since then, obviously, we have a lot more weeklies. We have virtually daily options to trade. And so a lot of people, when this first started out, was like, nah, this is never going to make it. Nobody's going to trade them. And, it's only going to be the mom and pop traders, retail traders trading them. But as it turns out, and as we'll talk about a little bit more, it's really the institutions that are really driving the order flow and the volume of weekly options. So we're basically using weekly options for hedging and taking advantage of short-term market movements, take advantage of economic events, earnings, say FDA announcements, and they really have changed the industry and really changed how options trade and driving order flow and what have you. So these weekly options have taken traders really to the shortest duration options. And when you have Monday, Tuesday, Wednesday, Thursday, Friday options trading, you can really customize exactly what you're doing and really hone in on, especially for short-term trading. And that's going to be a little bit of our focus here is using weekly or daily options to kind of do some day trading. So in 1973, taking you through a little bit of a history of options, CBOE lists the first standardized call options. I'm sure most of you haven't been around that long. And in 2005, I guess I was a little bit late in terms of what I thought. So 2005, CBOE introduces the first weekly options pilot program. Um, and quite honestly, it was only available on the major indices, the SPX, the NDX, the RUT, and maybe the SPY. And it wasn't really well received. It really didn't take off for several years until they really started introducing and making more weekly options available. So when they would do 1 week at a time, not many people really wanted them, but you'll see in a minute that a lot of these options came to be, and you started seeing multiple weeks of options showing up on the boards, and that's when they really started taking off. When they only did 1 week at a time, they weren't so popular, but now you can see you can go out 115, 120 days and see the weekly options intermixed with the monthly expirations. And then so starting in 2016, we started seeing more midweek options. First started with Monday, Wednesday expiration. So you had one expiring every other day. And eventually we're down to zero DTE options, which is basically options that are expiring 5 days a week, and we have that on most of the major indices, but not yet on all stocks. But there's no reason why that can't happen. So who trades the weekly options? Well, obviously we do, retail traders. We use a weekly for to trade around news events, to trade earnings, and any particular market catalyst that we have. Institutional investors also use weekly options to hedge event risk. And you probably might think that more volume is generated by retail traders or the mom and pop traders, but in reality, institutions are a major player in the daily and the weekly options trading. Helps them manage their exposure, take advantage of intraday opportunities, and you can see it right in the daily options that are trading in the volume. And when the algos take control after a news event, taking advantage of the shortest duration possible is the way they do it with weekly options. So, a lot of option sellers like it because more rapid time decay gives them flexibility. You can do spreads, you can do calendars, you can do butterflies on a daily basis, and you can go home flat if you want. You don't have to worry about carrying an option into the next day and what might happen overnight. Um, the pros of weekly options, obviously, a lot of flexibility. You can fine tune your market exposure for any particular events, as we said. A lot lower premiums if you're a buyer of option. If you want a day trade, if you want a short-term trade, shorter duration means there's less time value, making the contracts cheaper. Um, if you're selling options for premium, say you're doing covered calls, um, you can rinse and repeat every week, and you can compound your income on those options uh, every week rather than every or once a month. But with that comes some of the cons that, with options, you have higher risk. So the rapid time decay means that if you are buying the options, then you don't have much time to be right. And kind of a cardinal rule in trading is that the shorter the time frame, the more risk that you have in those particular options. So you can have a small move and it can wipe out value really quickly. And especially when you're talking about 0 days to expiration, zero DTE options, those options, if the market takes an intraday move, and it's not just the value. I mean, the value can come back by the end of the day, but it's also the psychology of watching. If you have, several options that are long and the market or the stock takes a turn for the worse, it's disconcerting to watch your, $2 or $3 option, float down to double digits or less than a buck, and then only for the market to turn around and you sell out because you're stopped out, and it goes back to the $2 or $3. So the psychology of shorter term options means that most of us are not going to be that comfortable with just giving ourselves less than a day to be right, or even less than a week. Obviously, repairing your trades is more difficult because you don't have the time on your side to do this. If you're a seller of an option, that's obviously an advantage. Um, when you have weekly or daily options, the bid-ask spreads are definitely wider. You don't have as much open interest there to take advantage of. And, you know, you're going to have higher transaction costs. And whether you're buying or selling a weekly option, a daily option, or a monthly option, commissions are pretty much the same. And um, what happens with these, especially for those who ask me about doing weekly covered calls, um, the management effort is tremendous. I tried that myself, trying to do weekly covered calls, and um, I just didn't feel like the juice was worth the squeeze, as they say. It's a lot of work. It's a lot of management. And if you're collecting that much less premium and you're subject to a lot of the gamma squeeze, um, you're going to be selling something for not so much premium, and you're going to have your stock taken away for you, and it might not be particularly worth it. And that's why I'm an advocate of more time. But I recognize for shorter term players, day traders, options are a godsend because you can hone in on what you want to do, get in and get out, and get on with your day. So the evolution from weekly to daily options, kind of what happened, kind of extending the history a little bit. 26 to 22 exchanges were responding to uh, demand for more expirations. 2023 daily expirations started coming about after the Monday, Wednesday, Friday. We started seeing Tuesday and Thursday expirations, and now we have PM expirations for a lot of the major indices. So when you have something like a triple witching expiration, which happens every 3 months, that's basically mid-March, mid-June, mid-September, and mid-December. That's when um, futures expire, and options on indices and stocks expire. So that's triple witching. There used to be a fourth um, futures on single stocks, but we haven't had those since I think around 2017. So some people call it quadruple wishing, but this is no longer true. There are no single stock futures out there, so it's really triple witching. And so what happens on triple witching is you have an expiration of options that will happen at the open on the third Friday of the month, or the quarter end. And then there will also be a PM expiration, and that happens for both futures and a lot of the indices, not so much in single stocks. So having these daily options facilitates really short-term trading and a lot of day trading. Hedging your portfolio, obviously. You don't want to if you don't want to spend a lot of money and you're worried about some type of binary event. And if you want to take more risk, you can do it for less money. But again, you want to do this in terms of buying and keeping your risk managed with size and what have you. So, um, obviously, when you have weekly options, selling for income can be very lucrative, especially if you have a sideways um, a stock or a market that's going sideways. The cash secured puts on a weekly basis, you're not going to collect as much premium for them, but you can kind of lather, rinse, repeat, and keep doing this every week, and until you possibly get assigned. But again, you're not collecting a lot of premium. You got to um, understand the trade-off between lower premium. Obviously, if you're selling four weekly options, uh, let's say all things being equal, you're selling four weekly options versus one monthly option. You're going to collect more premium on the weeklies. It's just the way it works. But you also um, are taking more risk, gamma risk, vega risk, volatility risk, and event risk with those weeklies, because things can quickly change. And as mentioned before, you don't have as much time to adjust for them. Um, Out of the money credit spreads, iron condors, you can do those. It makes them ideal for range bound or low volatility weeks. And you can define your risk and collect premium. And I've done that pretty successfully, but it is, again, time consuming, and the management has to be there. You have to have time to adjust and manage things. So weekly options offer flexibility, specificity, and opportunity for both retail and institutional traders. But it requires discipline. You don't want to get carried away with those weekly options because the tendency is, the shorter the time frame, the more often that you're going to lather, rinse, repeat, and it's going to cost you more money. And sometimes, if we lose money in one trade, then we try to make it back in the other. You want to be aware of liquidity and making sure you have fine open interests, and you've got to, I mean, this goes for all trading. You want to have strong risk controls because you don't want to get wiped out on any one trade. And I like to say no more allocation of more than 3% of your account value to any one trade, and even less than that when you're doing weekly options. So weekly options has transformed the landscape as it's gone to daily options, provided a lot more opportunities for traders. But again, the shorter the time frame, the more you have to be aware of the risks. So let's pause here. And before I go any further, let's kind of go into Thinkorswim and talk a little bit about weekly options. And as you can see here, um, in yellow, you have the weekly options expiration and daily. So we have options expiring on Monday, the 15th, 16th, and 17th. I'm in the SPY, and 18th and the 19th, which is a triple witching expiration coming up Friday. If I switch over to the SPX and take a look at that, give it a chance to come up. You can see now on the 19th, we have an AM settlement, which means that as of Thursday evening, you won't be able to trade these anymore. And come Friday morning at the open, there's a settlement price. And since SPX is a cash settled index, meaning you can't be assigned on it, you're going to, if you have some of these and they close in the money, you're going to have that option settled to cash as you would with the NDX or a VIX option or a RUT option. So you can see an AM settlement and a PM settlement. And take a look, if you will, all these yellow lines with the weekly options. And obviously now we have a quarterly option expiration as well. And we have a lot of weeklies that are basically dailies. You got 1st, 2nd, 3rd of October, now the 6th. We come to this week, we have Monday, Tuesday, Wednesday, Thursday, twice on Friday. Here we go, Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday. And we can keep going out. If I scroll down here, you can see that we have weekly options. And obviously, the further out in time, the less frequent they become. Out to October 21st, you can see 24th, you still have kind of daily options. But now, come October 31st, the end of the month, you got weekly, weekly, weekly. You don't see the daily ones until later, and they get posted. And I want you to see something, and this is SPX. I'm going to switch back to SPY. I will come back to the SPX. But let's take a look at Monday's expiration, and I'm going to shorten this to a lot fewer strikes. And take a look at what we have on the 15th of September. 47,000 at the money calls at the 657 strike. Traded on Friday alone. I mean, this is Friday volume still, with only a 2,400 volume. I wish I had the Friday volume, but look at the volume for the 15th of the out of money calls, 118,900 calls traded on volume of 2,000, on open interest of 2,609. Not so many on the put side. And this is just Monday expiration. And SPY is one of the most liquid options that you can trade. Um, let's look at Tuesday. Well, not as much, but 13,593, 10,000 there. And obviously, next week we have an FOMC meeting. And if we look at the over here, we can see where I'm pointing the options applied expected move into Monday is $4.06 on the SPY. On Tuesday, it's $5.50. Implied volatility rises a little bit, but look at the jump in implied volatility to 13.4. We jumped to a 7.4 percent volatility, or 7.40. That's plus or minus expected move. And of course, the 17th is FOMC day, where we get the FOMC decision on interest rates. And while we don't have a lot of volume here, and we don't have a lot of open interest, this is still a lot for a daily expiration. And some people ask, well, what is zero DTE? Well, zero DTE is when you're trading that day's options. And so if you're a day trader, you know, the same rules apply to weekly options as you do any other options. And that is, you want to choose liquid underlyings and you with a high open interest. And so with SPY on these dailies, you can see they have, a couple thousand, more than 750 contracts. So that's plenty of open interest. And as we know, SPY is very liquid with, penny or a couple penny wide spreads. Here, look at the volume of puts come Monday. 98,000 there, 109,000 there, 49,000. But as we look at we don't have a Friday AM expiration for the SPY or the QQQs, but you can see here on Friday, we have about 11,000 open interest here, 30,000 at the 655 strike, and then 12,000 on the put side. So, and plenty of volume on Friday for these expirations, even out of the money. So you can see that trading these is very easy to do. And let's walk away a little bit from, no, put the right symbol in, AAPL. Marquee stock to trade was up $4. And Apple has just weekly options, and you see they go out to October. So you have 5 weeklies to choose from. And as we go out in time, you can see there's more. And so next week is a monthly expiration, so you're not going to see weeklies. And I would fully expect that at some point, Apple will get Monday and Wednesday expirations, and eventually, maybe every day. It just depends on the demand and the volume. But here's next Friday's. These expire in 6 days. All right. Apple has a $6.46 expected move into next Friday's expiration. And you can see there's quite a bit of volume into just Apple alone. Okay, and I'll show you a little thing here that you may not pay a whole lot of attention to, today's option statistics. And if you don't use Thinkorswim, I apologize. You may have a system that shows you better stats, but this is what I grew up on. This and Tasty Trade are the two platforms I trade on. You can see here in the option statistics a lot of useful information if you want to understand what's going on. And so on Friday, we had about 1 million calls in Apple trading, and 372,000 of them were at the bid or below. 448 were at the ask or above. This basically means there were more, let's call it market orders for buying Apple calls than there were perhaps limit orders at the bid. Somebody was selling at the bid, somebody was buying at the ask. But when you have more trading at the ask or above than at the bid, something tells me that people were paying up, and it kind of makes sense that the stock was up $4. Same with the put volume, and you can see 1,423 options were traded on the SPY. Of course, this is not a weekly expiration, but for all intents and purposes, this was a weekly expiration. This is a weekly expiration for next week. It just happens to be a third Friday of the month. Let's go back to SPY for a second, and let's talk about using weekly options to kind of do what you might want to do. So, whether you're thinking about a short-term covered call, and honestly, with a big instrument like SPY, a $657 instrument, I'm not likely to sell an at the money call for $1.55, a dollar, and which is kind of, I like to collect at least 1% of the underlying value when I'm selling a call, especially a covered call here. And if you go out of the money $1, you're collecting less than $1 for these options. So for the most part, I wouldn't be doing or initiating covered calls on such a large instrument if I'm not collecting at least 1%. But if I were coming in on Monday and I wanted to day trade, well, this is the sweet spot. Obviously, you have a choice of many options, but if you're day trading, there's no point in paying more for premium. And a lot of traders go out of the money and buy a whole bunch, and maybe you can make some money, maybe you don't. But I think that they're kind of missing the boat a little bit because um, this out of the money call, which costs you 55 cents, maybe you can buy 10 of them for 550 bucks at risk. It's a 35 delta, so you're going to move 35 cents for every dollar move in the stock, essentially. But I would argue that you're much better off buying the 655s or 656, buying fewer of them and giving yourself more um, uh, odds of being correct. Now, let's say you go for the 656s. You don't want to pay $3 for these. You've got a 61 delta, and again, that means that this is essentially for every $1 move in the spiders, you're going to your call is going to move 61 cents. In this case, if you wanted to know, all right, let's say you want to know, okay, what if the SPY moves up a dollar? What is my $656 SPY call going to be worth? And yeah, you could do the math, 61. Uh, but what you can do here is come look at one strike further in the money, which is $1 in the money, and you can see that it's worth 307, kind of midpoint between 303 and 310. So you can immediately say if the SPY goes up a buck, I just go $1 further in the money. I can see just about where it's going to price. Similarly, if the SPY loses a dollar after I buy it, again, I can use the delta and do my calculation. But all I have to do is go $1 out of the money, and I can see that this option will be worth $1.55. So, and while what I used to do a lot of times, whether I was day trading or swing trading or what have you, I used to go out and I said, I don't want to buy, a weekly call. I want to go out to the next monthly or maybe out monthly, give myself a lot of time to rewrite. But that's basically using a sledgehammer where just a hammer might work. And what happens when you go out and you pay for a premium, you basically if you're wrong, you're going to be losing a lot more money, especially in extrinsic value here. And so you want the right tool for the job. And my recommendation is okay. Even if you go further in the money here, the 654s, 73 delta, you're going to move 73 cents for every dollar that the SPY moves. And so you're going to get a bigger bang for your buck. Buy fewer of them, but don't be at risk of, sacrificing. In this case, this is out of the money, 97 cents at risk. Yeah, you can buy a whole bunch more here, but you've got time value risk and you have less of a probability of closing in the money. So when you're doing day trading or very short-term trading, and the same goes for the puts here. Look, if you really think the market's going to go down in the afternoon, here you're controlling 100 shares, say for a buck 52, or better yet, for $2. Um, you're going to have something that's uh, controlling a $657 instrument. And if you're right, and the SPY goes down $2, then your $2 is going to be worth $3.60. But on the other hand, if the SPY goes down um, $2, then it's going to be worth $1.10. So look at the power of using a daily option. And this also applies to weekly options, but not to the same extent, because here you have gamma in your favor, because the shorter time to expiration, the more and the faster that these options move. So look what happens here. If you bought the 659 puts, betting on a move down in the SPY by the end of the day, and I have no problem going out an extra day if you want to give yourself more time to be right. But beyond that, if you're day trading, you don't need to pay for extra time. And obviously, if you're day trading and you're putting a stop, say a 15 or 25% intraday stop, you can be quickly in and out and know if you're right or wrong right away. So if the 659 puts are what you buy and the SPY moves $2 up, now you've got a put that's worth 360, let's call it $369. So you went from $2 to 369. So you just made, let's call it $1.60 on this. But because of how options work, if the SPY loses $2, well, your option will go from $2 and 12 cents to $1.10. So you're down 50%. And so you can see here, as the stock moves in your favor or the underlying moves in your favor, your delta increases. Again, you want to know where your option is going to be trading. Um, just move up the same number of strikes that you're expecting um, the underlying to move. And if it's going against you, then you can see here the delta is getting smaller, and the lower or the worse it gets out of your favor, the less and less you're losing because the delta is shrinking. And you know, if instead you shorted, 100 shares of SPY, you have what's called, and we discussed, a hard delta, and that's never going to change. Your delta is going to be 1 or 100, whereas when you're buying options to do this, and especially weekly options, you can hone in on things and see that um, the options give you kind of an edge in trading short term. Going back to the slideshow, so one of the other advantages, if you have an account that's less than 25,000 and it's a margin account, go back here for a second. You can only trade the same instrument uh, 3 times in any 5 trading days, and otherwise you're classified as a pattern day trader. And then you get a restriction on your account, and until you get your account back up to 25,000 or more, um, you can't do any more day trades. And so having multiple expirations and daily expirations and different strikes. Um, the nice thing about weekly options, it expands the field of I guess, options that you can use to avoid the pattern day trading rules. So if you trade the 657s today and you sell out of them, that's one day trade. But if you go out and buy the 657s tomorrow and sell them, that's a different strike. It's not um, the same trade, so to speak. So you're not repeating that same day trade. But when you go and into other instruments, say you trade the QQQs or you trade another instrument, you're basically have a lot of different options to avoid the pattern day trading rules, which say that if you trade in and out of the same instrument 3 times in the 5 day period, then you're labeled a pattern day trader, and you are restricted from trading that account, or at least day trading in that account until you get that account up to 25,000. Now, I've heard rumors from Tom Sosnoff and the Tasty Trade crew that there is rumblings and action that by the end of 2025 we may be getting rid of that day trading rule after many years of fighting to get rid of it. So another thing I want to mention about um, trading daily options, if you're not online and trading, um, doing day trading with daily or weekly options, I don't recommend it. You can do it, you certainly can do it, but if you're not at your desk and you're not watching it, try to do this on the phone or an iPad while you have a full-time job. It's just a recipe for giving your money away. You've got to be able to do these while the market's open and you're at your desk watching these. It's not like a monthly expiration where you have plenty of time or you're doing a swing trade. So that was kind of it that I wanted to talk about, but there is more to this, and I will cover that in the next session. I hope you got something out of it. This is kind of an introduction into trading with weekly options. We'll get more into the approaches in the next session. I appreciate you watching and listening. This is Trader Geek Sam at Trader Geek on Twitter. Hit me up and follow me, give me a follow, and I will see you in the next video. Thanks for watching and share it with your friends. Take care. Bye bye.